Hello and welcome to CMS Forex News. I'm market analyst Nick Nassad. Today is Thursday, February 5th, 2009. The Bank of England cut rates by another 50 basis points today to 1%, extending its aggressive attempts to bring down borrowing costs. Within the last 5 meetings, starting in October, rates have dropped by 400 basis points in order to counter what is becoming a very severe recession. The UK economy is expected to shrink this year, and with the interest rate at historic lows, the government and the central bank have to try other methods to jumpstart lending and spending. One example is the government's recent move to give the Bank of England the power to spend up to £50 billion on bonds and commercial paper in an attempt to inject liquidity into its financial markets. In a release from the Halifax Bank of Scotland, showed a surprise increase in housing prices in the UK for January. Prices are up 1.9% on the month, and the fall in the annual rate was not as bad as forecast. This may be a sign that the market may be stabilizing, though there needs to be further corroborating evidence to warrant that statement. Despite cutting its UK rate, the pound-dollar pair moved strongly in favor of the pound following a test of 1.4365 in overnight trading. The pair set a new 3-week high at 1.47 after its 300 pip rally that was only accelerated following the interest rate cut. Traders are rewarding the currencies of central banks that are acting aggressively to try and stem their recessions. The European Central Bank kept its benchmark interest rate at 2% today. It's the first time in 4 meetings that the ECB did not lower its main rate, as it tries to wait and assess further data before perhaps cutting again in March. All of this was signaled to markets beforehand, and the euro has been falling as a result. Traders believe a move was necessary as the Eurozone economy continues to sputter at the start of 2009 and rates should be lower. Manufacturing orders in Germany dropped more than expected in December, extending the worst decline on record. Orders fell 6.9% on the month, following a 5.3% drop in November. Both domestic and foreign demand saw significant pullbacks, as did orders for both investment and consumer goods. From a year earlier, orders slumped 25.1%. These are woeful numbers and imply that the Eurozone economy will remain weak going forward. The IMF has predicted that the German economy will shrink as much as 2.5% this year. The euro-pound pair took another tumble today, falling 170 pips following a test of the 0.8930 level. The pair then broke below support at 0.8850, and today's low is the lowest the pair has been since December 10th. Again, traders were rewarding the pound for acting boldly, while the euro is being pressured by the ECB's insistence on holding rates and today's weak German factory orders. The euro-dollar pair slid following the ECB announcement, but found support at the 1.2760 level, and we had a pretty choppy back-and-forth session. At the end of the session, though, the pair's bears won out, pushing the pair back towards its low for the day. Still, the volatility here was lower than we have seen in the past 3 sessions. Turning to U.S. news, the number of U.S. workers filing first-time claims for unemployment benefits rose by 35,000 to 626,000, soaring past the 600,000 level, which was last seen during the 1982 recession. The data was much higher than economists' forecasts. It's a worrying sign that the raft of pink slips continues and the economy continues to shed jobs at an alarming pace at the end of the first month of 2009. Total people claiming unemployment rose to a record 4.78 million. That means those being laid off are finding it harder to find a new job. Factory orders in the U.S. slid 3.9% in December, which was worse than forecast. It was the 5th month in a row that orders were down, and November's total was revised lower as well. It's a sign that the recession is cutting deep into business capital spending plans. In a third release, U.S. companies, desperate to contain operating costs in the deepening recession, were able to squeeze out more productivity from their workers in the 4th quarter. Productivity increased by 3.2% annual rate, more than twice the amount forecast. Labor costs, meanwhile, climbed at a 1.8% rate, less than anticipated. The increase in efficiency was fueled by cutting millions of workers from company payrolls and cutting hours for those still on staff by the most since 1975. The dollar-yen pair broke out of its recent downward range, zooming 270 pips higher to set an intraday high at 92.25. U.S. stocks recovered from a drop in the morning and were up near the end of the trading session, which helped boost the risk appetite in this pair. Looking at the fundamental releases coming up to end the week, overnight brings us producer prices and manufacturing production data from the UK. Switzerland will also post its leading index, and Germany will reveal its industrial production. Tomorrow, the US will release its non-farm employment change, one of the most important releases, and expectations are for another 500,000 lost jobs in January. Canada will also post its employment change figures, and the UK will reveal a monthly GDP estimate. And that wraps up our broadcast for today. Thank you for joining us here at CMSFX.com, and happy trading.